Hello, this is Stacy Francis from Francis Financial. We're a fee-only independent wealth management firm, and we specialize working with women going through traumatic situations. It could be going through a divorce or, unfortunately, losing a spouse. Either way, the women that we work with know that financial security is very, very important to them. And for many of them, they've not really dealt with their finances on a real active, ongoing way. So the opportunity they have is to be able to set their futures up and feel financially secure, not only today, but for the long run. Today, we're going to be talking about our 2016 investment forecast and quarterly review. It's a fantastic way to start to get savvy about your money. We're going to be going through a lot of great information today, but don't worry. We're recording this, so if you want to listen in again or you have a dear friend or colleague or family member that could really benefit from having more savvy investment advice, you can definitely forward this to them. We've got a lot to go over today, so let's go ahead and get started. And today we're going to be going through a couple different pieces. Specifically, we're going to be talking a little bit about our role as financial planners, and in particular, as financial planners, what can you expect from a planner? We're also going to talk about the market review. How has the market performed over this last quarter? It's been quite a wild ride, and unfortunately, you're probably going to need a seatbelt for the next couple quarters going forward too. And then finally, we're going to talk about going forward. As I mentioned, you're going to need that seatbelt. And what is our investment outlook, and what is our portfolio positioning? And more importantly, what does that mean for you? So first off, your role as a financial planner, it's really to help other people, to help individual investors like you to be able to invest in a wise way. Unfortunately, a lot of investors have some big hurdles going against them. And there are four that we see most often. Number one, they try to predict the future. If I knew the future, if I had a crystal ball, trust me, I would not be on the phone with you right now. I would be probably somewhere in the Bahamas in 90-degree weather with a nice, cool pina colada with an umbrella in my hand. Others act on impulse. They bet their savings on tips or hunches what the taxi cab driver told them on the way to work. And I think the biggest faux pas is that they're swayed by the media. So let's talk a little bit more about this. So trying to predict the future. There are a lot of pundits on TV that do exactly just right, that say that they have a proven system for picking that perfect winning stock. Well, can I tell you that if you look at those perfect winning stocks, most of them are not winners in the long run. And in fact, when you look at the trading performance of day traders who are trying to pick that winning stock versus financial planners or individual investors, we see that those day traders underperform by upwards of 6, even 8% a year. So another thing we hear is that sector is going to do great. Let's put all of our money in there. Or the market is going to go into a retreat. We're going into a bear market. Let's take all of our money and put it into cash. These are some of those, again, trying to predict the future. Is that going to happen? Well, here's an example of back many years ago when they said that it was a world meltdown. Funny enough, it actually wasn't a world meltdown, but this is something that we often see quite ongoing. They act on impulse, such as, I can't take this bear market. I'm getting out. This is too much for me. Or everyone's making a piece of the action. I want a piece of this. My neighbor said that they got a 10% return in one quarter. Well, unfortunately, this is another piece that really drives what people do with their portfolio. So here is an example, the crash. And you read really scary topics, scary titles, and it causes people to not think about it, but actually to act on impulse and make changes to their portfolio. They bet their hunches on tips, such as, I heard on the news I should sell. I better sell now. I got a tip from my neighbor when he was washing the car. It's a slam dunk. I'm going to put my money in that stock. Or my friend works in the industry and he's got the inside scoop. This pharmaceutical stock is going to go sky high. These are a lot of tips and that you'll often see. You'll often see them in, the mass media magazines such as Fortune, Forbes, and not to, again, pick in any way on the news industry, but know, again, that the news is meant to sell what? Publications. And you sell more publications if people feel a fear that they're going to make a mistake if they don't have your publication. So we all know that we need to invest. And a question some people say to me is that, well, maybe I don't need to invest. Is there a way that I can just not worry about investing in the stock market, especially because I don't feel comfortable? Well, here's an example of not investing. And so I have here something that we all like to drink, milk. And I remember back when I was young, I remember when the gallon of milk hit the $1 mark. And I recall it was an unbelievably big day because when I went in to go get that gallon of milk for my mom, instead of just $1 and be able to give her change, I went in and I didn't get to keep the change anymore. So for me, I'll be honest, it was kind of a catastrophe in my name. I never got to keep the change from going in and getting that gallon of milk. Well, 9 cents back in 1913 would have gotten you a quart of milk. In 1963, that 9 cents would have gotten you a glass of milk. Today, 2014 and beyond, we're seeing that 9 cents is going to get you a full 6 tablespoons of milk. So what does this mean? It means that your dollars need to continue to grow. You can't just keep your dollars on the side in a bank account. You need them to grow for you. Investing does mean taking risks. But not investing, as we can see here, also means that you're taking risk. So what should you focus on? The most important thing is to create a plan. Create a plan so you can make smart decisions about your money. And what are some of those decisions? Well, number one, choose the best investments for you and your goals. Number two, try to have it be as low cost as possible. 3, pay as little in taxes as possible. And then sticking with your plan. And then adjusting your plan as your goals change and as your life changes. So let's talk a little bit about choosing the right investments. Now this chart here, I will definitely agree that there's a lot going on. And let me show you how to read this, because this is a chart that is going to completely change the way you think about investing. So we can see going over here in 2005, we have the emerging market stock category, so EM, that stands for emerging markets. And in 2005, you were really excited to be invested in emerging markets because you had a return of 34%. Pretty phenomenal. What did the worst here? You can see all the way down here. World government bonds actually had a loss of almost 7%. Now what's interesting, we're just going to track the history of emerging markets. You can see that this chart allows you to track everything from large company U.S. stocks to small company U.S. stocks, international developed, international emerging markets, all different kinds of bonds, and even cash. So if you really want to dive into this, you can really see the performance of all of these different asset classes. But we're going to just look at emerging markets. So 2005, you had a 34% return. 2006, you were happy to be there too, 32%. 2007, 39%. But then look at this, 2008, what happened? The worst performing asset class, the worst performing, emerging markets, a negative 53% return. You couldn't have gotten into any performance worse than that. But look at the next year. Look, 2009, a 78% return. I don't know about you, but I would be pretty darn happy with that. Then you see it has about an 18% return. And then again, the worst performing. But then 2012, the best performing. What am I saying about this? Why am I showing this what looks like a very exaggerated history of one individual asset class? The reason why I'm telling you this is because your goal, our goal, is to invest across as many categories as you possibly can. Because a diversified portfolio, which is essentially saying not putting all your eggs in one basket, is very important. It helps curve the ups and the downs, what we call volatility, the extremes of any one year. Could you imagine if in this case you had only invested in emerging market stocks? I don't know about you, but just even looking at this chart makes me feel like I need to go get a Tums. But if you had had exposure in addition to that to large company stocks and medium and small, international developed, as well as different types of bonds, you would have felt much less extremes through this process. And it's really important to have all different asset classes in your portfolio. So the next piece that's really important to learn about, and it's perfect timing since today is tax day, is what you pay in your taxes. So in investing, there are the taxes you paid and then the tax you could have paid. I would suppose that every person part of this session today could benefit from paying less in taxes. And what's unique about investing is that you don't add any more risk by being tax efficient. What does that mean? Well, you've got two different types of accounts. There are non-retirement accounts, like your brokerage account that you might have, and then you have your retirement accounts. That could be called your 401k, your IRA. For some people have a SEP IRA or a 403b. By being smart about what assets to put in your tax-inefficient retirement accounts your tax-inefficient retirement accounts versus your tax-efficient retirement accounts gives you a huge benefit. Non-retirement accounts, you have to pay taxes on any of your earnings in them each year. Similar to when you have to pay taxes on the piddling and interest that you make on your savings account at your bank. Right then, that year, you have to pay taxes on that interest. As such, you want to put the most tax-efficient investments in this type of account, your non-retirement account. However, you're going to put your least tax-efficient investments in your retirement accounts. The reason why you're going to put those least tax-efficient investments in that retirement account is because your retirement accounts grow tax-deferred. When you earn $1, $2, $3, $4 in dividends, interest, or capital gains, you don't have to pay taxes now. You can pay taxes way down the line when you're 70 and a half and take the money out of retirement. Some assets you have to pay a lot of taxes on, like bond interest, for example. So being smart about having to pay a lot of taxes on bond interest, let's put those bonds in your retirement accounts so you don't have to pay taxes on them right now. Instead, for your non-retirement accounts, the accounts that you have to pay taxes on any earnings right now, let's put things in there that produce very little in taxes. So capital gains. Any capital gain assets, so any stocks or so, you pay taxes at a much lower rate than you would necessarily on bonds. So it's being smart. It's being smart about reducing your taxes. It doesn't mean that you are going to change the mixture of stocks and bonds. No, that's always going to stay the same. But where you put those stocks and where you put those bonds is really important to make your portfolio grow for you over the long run. So let's talk about investing. This is my favorite slide. And how you read this is essentially on the left, you see the percentage difference in annual returns. The percentage difference in annual returns is a percentage that is identified by these 7 different research companies that used different methodologies to essentially look at the performance of individual investors versus investors that work with financial advisors. And interestingly enough, what they found is that individual investors, according to Dalbar, underperformed those investors with financial advisors by 4.3% a year. CAS, it was underperformance of about 1%. You can see here in the dotted line, Dalbar had a second type of analysis, not only for individual investors versus those working with an advisor, which here showing they underperformed by about 1.5%. But they also looked at individual investors versus day traders. And interestingly enough, day traders underperformed by 6.5%, a really big number. So how is this? Why is it that people do so much better working with a financial advisor? Can I tell you, it's not what you expect. So here's an example. This is a chart showing what happened after the financial crisis in 2008. What individual investors did is they started to add a whole lot of safe, conservative bonds to their portfolio. They increased their bond exposure. And instead, what did they do with stocks? They decreased their exposure to stocks. So, for example, if they had a portfolio of 80% stocks and 20% bonds, after 2008, they switched that. And they might have switched it to maybe only 50% stocks and 50% bonds. Now, what's interesting is we track to see what did advisors do? What did advisors do? And this is what happened, exactly the opposite. So here in 2008, advisors, here in gray, added stocks. They increased their exposure to stocks. Whereas retail investors, the average person on the street, as we just saw in the previous chart, they actually decreased their exposure to stocks by a large amount. Interesting, the exact opposite behavior. I'm now going to talk about your average investor versus a more opportunistic investor. Opportunistic investors, as defined here, is essentially those people that saw the market go down 8% and said, guess what, I'm adding money. I'm going to add $2,000 every single time the market goes down by 8%. Now, apprehensive investors, they did exactly the opposite. Every time the market moved down 8%, they took $2,000 of their portfolio and they put it in essentially cash. What's interesting is if we look at the trends over time going back to 1975 to where we are today, Those people that had invested $10,000 and continued to put more money in when the market went down, and those people that had $10,000 and then took money out and put it in more reserves, we had a difference of almost $700,000. They invested the same amount, but the difference in their returns were almost $700,000. Those that were opportunistic, that saw a market decline and added money, which you can see on these little dots when they did that, had $1.1 million. Those that saw market declines of 8% and took money out, as we can see here, and put it in a more conservative fashion, had only $397,000. I'm not saying that every time the market goes down, you need to throw a bunch of money in. But I'm showing you this just to show the huge differential between supposedly playing it safe and taking money out of the market when it goes down versus being aggressive and being, some people might even say, a little crazy, putting market in when the market's going down. You can see that over time that it really does pay. Now, I know this sounds crazy. Can you imagine yourself sticking with your portfolio in good times and in bad? Well, I do agree. It's not the easiest thing to do because you have the lizard brain working against you. And while I went through biology, I will be honest, one of the worst days was having to dissect a frog because I love frogs. I did take away a few things from biology, and in particular, the way our brain works. Investing is definitely what I think it's challenging enough without having to bring emotions into the equation. But guess what? We are emotional, and our emotions actually drive the way that we invest. And I will say this. It's true. We put too much reliance on our feelings about the market rather than looking at the real data. And the real data is not the scary front page cover on Time magazine. The real data is what I just showed you. It's this right here, that being in the market over the time versus pulling your money out is the smart and the profitable things to do. So this part of the brain that makes our decision making, particularly when it comes to investments, more difficult is the amygdala. The amygdala is a part in your brain. You can kind of see it right there. It's an almond-shaped tissue in your brain that controls essentially our urge to flee from a lion. Well, we don't necessarily have that fear anymore in the sense that we're not normally being chased around New York City by lions, but we definitely have that lizard brain that's running in full gear, running away from anything that could threaten us. And the market going down is almost the same result in our brain as a lion running after us. A great example of this actually happened pretty recently. It was August 2015, and there is a so-called fear gauge. It's a gauge that really measures how fearful are individuals in the market. And we saw the fear gauge going to an unbelievably high level of 53. But what we found right after that is we saw unbelievably positive performance. So even though we have the fear gauge saying that the world is going to collapse, you can see that that does not necessarily result in what's going to actually happen in the market. So how do we get over this? Well, it's just really understanding the biology of this. And the biology is that a loss of $50 here, that you can see here, a loss of $50 is twice as painful as a pleasure that you gain from gaining $50. You would, in common sense, expect a gain of $50 and a loss of $50 to be, pretty proportional in this manner. But you can see that that's just really not true. So every person is different. Every person's appetite for risk is also different. And the optimal amount of risk taken by you is really dependent on what you need to do with your portfolio to get to your goals, as well as your time horizon. How long until you need the money to pay for that goal? So if you're coming up to retirement and you're in your early 60s, your portfolio most likely is going to have less risk in it versus when you're 40 and you might have another 20 years to go. So these are all things to think about when you think about your portfolio. It's based on your goals. It's also based on your time horizon. So do you remember how we talked about the chart where we saw individuals, investors, underperforming those that had financial planners? Well, I'm going to tell you why they underperform. And at first when I read this information, I will be honest, I kind of had a little swagger. I thought, it's because we financial planners, we investment advisors, we know the right investments. And we hold your hand, and we're doing such a great job. Well, can I tell you, that is a piece of it, but there's even a bigger piece that makes much more of an impact over time. This is the real reason right here in this chart why individual investors underperform. It is the biggest investing mistake. When the market reaches its heights, we see individuals buying more. The excitement builds, the market rises, investors are excited about performance. Those that have not been in the market want to join in, eager to join those good times. No one wants to miss out on this amazing opportunity. And so people pile in more money into the market and invest more. But then, unfortunately, as you would expect, as always, there are different fluctuations in the market, and the market can go down. And at this point, we start to see something else happen. Investors start to worry, and they become increasingly wary about seeing their stocks fall in value. And they decide that they better sell sooner than later. Towards the bottom of the cycle here, they actually sell, turning a temporary market decline into, unfortunately, a permanent loss. And then the market goes up. They're feeling more comfortable. Prices rebound. Confidence regained. And they're ready to start investing again, right here at the peak. It's a same cycle of emotions over and over again. That's what happens to our average investor. Whereas working with an advisor, instead we're using these opportunities. When we're reaching the top of the market, we're selling. When we're reaching the bottom of the market, we see for sale sign, and we're buying. So I say this, spoken by a truly brilliant man. Be fearful when others are greedy, and greedy when others are fearful. This is a perfect example. In 2008, we know what happened. There were several people, hopefully none on this call, that sold out of the stock market and stayed out. Well, they still have losses in their portfolio, losses of almost 7%. They never recovered. There were those that jumped out, and then finally, after the markets had recovered, they had more confidence, and they jumped back into the market after March 31st, 2010. Well, they're up. They're up 6.1%, so they've recovered. But what's interesting, look at this. Those that maintained exposure to stocks during the entire market swing, they maintained the same amount of stocks both in 2008 through the bear market and kept that same amount in 2009, 10, 11, 12, 13, 14, and 15. They have enjoyed a phenomenal return of over 21%. This is the importance of staying invested throughout. And there are some people that say, well, I'm only going to be out of the market a few days. I'm only going to be out of the market a few days. But what I want to show you here is that that isn't necessarily the answer either. In fact, those people, going back from 1995 through this last year, end of the year, those that stayed invested had a wonderful return of $654,000 after having invested $100,000. Now, those that missed 15 days, 15 of the top performing days that had invested that $100,000 only had $255,000. What would you like? Would you like $654,000, or would you like $255,000? And that is, again, just missing 15 days. In fact, just missing 5 days, look at that. That takes off $200,000 in performance. And that's just because they didn't stay invested the whole time. Now, I know that there's a lot of concern, particularly about oil. What should we do now that we're seeing so much volatility in the price per barrel for oil? We wanted to add this slide in here because we wanted to show you something really spectacular that you may not have realized. There is a trend, and here we have all these different time spans, and during that time span, how significantly the price of oil dropped. We have October 85 through March 86, oil had a 66% loss, drop in value. Interestingly enough, how did the S&P 500 perform? How did the market perform after this decline? It went up almost 38%. Look at these. After all of these very large declines, we see unbelievable rallies in the stock market. Now, we don't have an answer to what we've seen today yet, but we do know that oil has gone down about 69%. On average, what we're seeing is that when oil drops in price more than 50%, that we get returns of almost 27% per year in the stock market. So I know that it's very scary, to see the price of oil go down, but know that historically it's actually been a boon to the stock market. Now, what about corrections? If you're not worried about the price of oil, maybe you're worried about seeing the market performing so, well, let's be honest, crazy. Some days we're seeing really unbelievable returns and other days not. Well, what happens after we see a 10% correction? So we went back almost 100 years. We went back to 1928, and we looked at all of the 10% corrections. And how did the market perform after? Well, in the first 6 months after that 10% correction, it was a 22% return. In the 12 months after that 10% correction, it was a 24.68% return. Now, what if it was an even larger correction? Well, 6 months after a 20% correction, we saw returns on average of 27%. And this is the number that I think is most beautiful. 12 months after that 20% correction, on average, historically going back over almost the last 100 years, the market returned over 40% in 1 year. I don't know about you, but in my mind, that's a really amazing return. Let's talk about the S&P 500 and the dips. This is a chart that shows you anywhere below our line here in the middle shows you dips. And we can see some pretty big dips. We have the dip of 2000, a 9% loss, 2001 and 2002. But that you can see shortly following that in 2003, 4, 5, 6, and 7, some really nice returns. We saw the massive dip in 2008, but then look at this. 2009, 10, 11, 12, 13, 14, really nice returns. Market drops, for us when we look at them, we actually look at them as big opportunities, and so should you. Do you remember that fear index that I talked about? Well, it turns out that the fear index also shows potential gains in the market. It's interesting, when you buy stocks, when fear is running historically high, it's often led to much higher long-term gains. So what's considered extremely high fear is when what we call the fear index is 40 or higher. And you can see all of these dates here in the pretty colors. We like colors. We're girls. But you can see these pretty colors of these different dates when that fear index was 40 or higher. And you can see what happened over time after these fear indexes. Very, very high fear indexes. You could see that the returns were much, much higher over time. What stoked the fear? Well, you can see these were the one-day losses. So the fear in 98 was the Russia's economic crisis. There was a loss in 1 day of almost 7%. We saw in 2008 a loss of almost 9% in 1 day. In 2011, we had a loss of almost 7%, and that was due to the European debt crisis, the S&P downgrade of U.S. government debt from AAA to AA plus for the first time in history. So where are we at now? We do definitely have a loss. We almost had a 4% loss in 1 day, and that was based on the China's currency devaluation. What are we going to see for our next 1 year, 3 year, and 5 year return? I'll tell you that it's probably going to be better than you expect. So why work with a partner? And that partner could be an advisor, but it also could be a friend, a family member, someone who holds you accountable to do the right things, to not be swayed by what's going on in the market. Well, we say it's for gains. It's for knowing that gyrations are normal, that allocation is key, the mix of stocks and bonds and different types of assets, investing for the long term, never letting emotions drive decisions, and that savings is most important. It's the one thing that you truly can control. It's also helping you adjust the plan. Having that proper mix of stocks versus bonds, changing the plan because your life is going to change, your goals may change, and guess what? So does your plan. And it's also rebalancing it and being smart and doing that buying low and selling high. So buying when stocks are essentially on sale and buying when they're really, really expensive. Now, we talked a little bit about knowing that over the next couple of years that the market's probably going to do well, but you should have a question for me. What part of the market? So let's talk about what happened to the market this last quarter, and then we're going to talk about what is going to happen in the future, or what is more likely to happen. So here we have all different types of markets. We have U.S. Treasuries, which is very conservative. We have bonds, municipal bonds, floating rate, high-yield bonds, large company stocks, small company stocks, developed international, such as Canada, Germany, England, and emerging market stocks, such as China, India, Brazil. We can see how these asset classes are performing so far this year. And what's interesting, almost all the asset classes were up this quarter. Which asset class did the best? Well, our favorite. Emerging market stocks were up 5.9%, almost a 6% return in 3 months. That is phenomenal. It vastly outperformed U.S. stocks, vastly outperformed small company stocks, and also outperformed developed international. We see that emerging market stocks really, again, were leading the way, and that fundamentals in emerging market countries are starting to look much better. What we see here is manufacturing PMI, which is an indicator of strength of an economy and grow. And you can see that emerging market countries had a big dip here, but look at what happened in this last quarter at the very end. The strength of manufacturing in these countries improved vastly. So we are telling you that we believe that there's more strength than maybe many people had feared. I'm not saying that China in particular doesn't have problems. They do. But emerging market stocks have been pummeled in 2014. And we believe, and based on our modeling, that emerging market stocks are trading at a very attractive rate right now. So let's take a look at what has happened, particularly with U.S. stocks. So here we have net margins versus average margin. Historically, very high profit margins have been followed by sharp declines in company profitability. And that's actually what we're starting to see right here. You can see very high margins and then all of a sudden a drop in margins. That's part of the reason why we're not seeing huge gains from U.S. stocks. Now, what about bonds? Are bonds the right place to go? Well, bonds have done fairly well this year, about a 3% return for this year so far, but we don't expect huge returns necessarily in the next couple years. So let's talk about where should you put your money. Well, this quarter was the tale of two halves for global markets. It's interesting. The first part of the quarter, from January 1st through February 12th, almost every single asset class was down. When we looked at the last part of the quarter, so that's February 12th through March 31st, look at this. Look at these unbelievable returns. Remember when I said times of massive drops often are followed by times of massive increases? Emerging market stocks went up almost 18% in 6 weeks. U.S. stocks almost 13% in 6 weeks. Developed international 12% in almost 6 weeks. These are phenomenal returns. But essentially, this quarter was very interesting, and I think it is the perfect quarter to explain the importance of staying invested. And here we go. Here's another way to look at this. This is a more visual way. And you can see on the left right here, the losses, the very large losses that you see across all of these different areas. And then the second part of the quarter here, how almost all of them have gains. So let's talk about what's going to happen, though, with interest rates. Well, interest rates, as has been explained by the Federal Open Market Committee, they held their mid-March meeting, and they decided not to raise interest rates. Their reasoning is that the global economic and financial developments are continuing to pose risk. So going forward, when we look at interest rates, which this chart shows us, the Fed funds rate, we expect that the rises are going to be very slow and very moderate, which actually is good for you, because slow and steady wins the race. This shows you times where we had very slow cycles of increasing interest rates, and then also in blue, fast tightening cycles where they increased interest rates very quickly. And over time, what we've seen, the performance of the market, the S&P 500, that in those times that we see slowly increasing interest rates, which we see very, very clearly in orange, the market actually does better and performs better than in historical times where they increased interest rates very quickly, as we saw here. I don't know about you, but I want the market to do better. And so slow and steady with increasing interest rates, which is what the Fed is saying that they're going to do, is actually good for you. And it's resulting in one of the longest current recoveries on record in terms of the length of time, the duration, and the magnitude. We're seeing that we don't think that this expansion is going to stop. It could possibly continue for a few more years. Another reason why you want to stay in stocks and not move all your money to bonds. But what about from the U.S.? Is that where we're going to expect most of our returns? Well, the average growth of the U.S. economy, what we call GDP, since World War II has been roughly on average 3.2%. However, the Federal Reserve is projecting that the longer run growth is only going to be 2%. Well, the economy is in decent shape overall, but what we're seeing is that it's going to be growing at a slower rate. It means that while we do expect a continued expansion going forward in the stock market, but that the next 5 years, we're not expecting as high returns as we saw in the last 20. So here in this beautiful teal, which is my favorite color, we saw that our average return from 1986 through 2015, on average, your returns, if you invested in the S&P 500, which is the 500 largest stocks, your return would have been 10.4% each year. What we're saying going forward, we're going to still have some nice returns, but unfortunately they're going to be smaller. For bonds, had a really nice 6.8% return historically. Going forward, well, not so great. So where is this return going to come from? Why are we so bullish about the stock market? Well, we are excited about international. And here we have a chart that's just showing you the change in current account balances versus the growth of these countries. And you can see that for Vietnam, Thailand, Korea, Malaysia, Philippines, Hungary, Czech Republic, Slovenia, Hong Kong, Chile, Peru, Argentina, Poland, Russia, India, for almost all of these countries, their their figures showing the strength of their economy has actually improved. That's good news. And in fact, we're seeing that these economies, emerging market economies, are growing faster than those economies in the developed world. So even though we're seeing here in the U.S. that the growth is going down quite significantly, we're seeing in developed economies and developing economies a real excitement. So here we're seeing in this teal color here, this grayish teal color, increasing in growth in developing countries. This is where we expect most of the returns to come from in portfolios. In Europe compared to the U.S., they are tracking at much better valuations. Here we have the PE ratio for Europe being much lower than the PE ratio for the United States. What does this mean in plain vanilla? It means that stocks, U.S. stocks, are priced much higher than stocks in Europe. So it being much more likely, much more potentially worthwhile to make sure that you have exposure particular to Europe. Here's one of the last slides I'm going to show you. And I know we've gone through a lot of information, but this slide shows you estimated returns across several different scenarios: a bear case, a bull case, and what we expect and what we're seeing, which is called the base case. This chart shows you the estimated annual returns over the next 5 years. And for U.S. stocks, we're showing a return of potentially 4% each year. For developed international, particularly Europe, look at that, a 13% return. Emerging markets, 11% return. Real estate, 4% return. And the real bright spot in bonds are the area of high-yield bonds and floating rate loans. So these are really important things to keep in mind. The portfolio of the 80s and even the 90s, where you had U.S. stocks and U.S. bonds, is not going to do it for you. It's not going to do it for you because your portfolio needs to be diversified. And what diversified means in 2016 is also having exposure outside of the United States. It's that exposure outside the United States that's going to yield you some really heady returns. Now, know, though, that there will be times when your portfolio is up, also going to be times when your portfolio is down. But please remember that be fearful when others are greedy, and greedy when others are fearful. Because investing does mean taking risk, but not investing means taking risk too. And you want to think about your portfolio from the facts of what you've seen historically and why it pays to be diversified and stay in the market, and not let your emotions take over. When you see what I call financial porn on the front of Kiplinger's, Time, Fortune, or Forbes, know that they're doing that to sell newspapers, to sell magazines. They're not doing it for you. So be smart. And continue to educate yourself. Continue to get savvy about your money. 80% of individuals have said that a second opinion about their portfolio, their investment plan, would be beneficial. So if you want to receive a personal analysis of your current situation at no cost, please reach out to me. You can reach out to me at info@francisfinancial.com or Stacy, Stacy, at francesfinancial.com. You can also reach out to me. We'll look at your portfolio. We'll review your goals. We'll look at your time horizon to make sure that you're on track to reach your goals. And one of three things can happen. One, it could be that you have a beautiful portfolio, you're on track, and you're working fabulously with your advisor, and that's fabulous. Second, it could be that there are massive changes that need to be made, but we're not the right fit for you. Or it could be that you have massive changes that need to be made, and we are the fit. But no matter what, you're going to walk away with more confidence, with more knowledge, and hopefully with more support. So I want to say thank you for your time. Thank you for investing in yourself and knowing that the key to financial security is definitely knowledge. Thank you, and have a great day.